I am about to show you 10 tax strategies that save my clients over $50,000 each year, and you can start using them today. These are not theoretical ideas or aggressive schemes. These are the exact strategies I implement every day with business owners who used to write six-figure checks to the IRS and now keep that money in their business instead. I work with trades and home service businesses doing between $1 to $3 million in revenue each year, and every single one of these strategies has been battle-tested with real clients. At the end, I'll give you the implementation checklist we use at HavenStone so you know which moves to make first. Let's dive in the strategy number 1. Pick the right entity structure and compensation plan. Most business owners know that an S corporation helps you avoid self-employment tax on distribution, but the catch is that you must pay yourself reasonable compensation. If your salary is too high, you're overpaying payroll taxes, which typically run around 15.3%. If your salary is too low, the IRS may reclassify your distributions as wages, and that can trigger an audit. There are two main ways to determine reasonable compensation: a cost approach and a market approach. And with the right strategy, the savings can be huge. At $800,000 in profits, you can save 20 to 40% on self-employment taxes, and even at $100,000 in profit, saving $10,000 is common. The key is to revisit your compensation study every year as your business changes so that your structure and your salaries stay aligned. And then once you have your structure and compensation set, the next strategy is turning everyday life expenses into legitimate business reimbursement. A lot of business owners pay for things out of pocket without realizing that their business can reimburse them tax-free. With a proper accountable plan, you can turn part of your home and lifestyle expenses into deductible business reimbursements like your phone bills, internet, property taxes that tie to your home office, cleaning services, landscaping, coffee machines, printers, and anything legally tied to business use. These reimbursements are tax-free to you and deductible to the business. And with the right structure and documentation, many owners save $5,000 to $15,000 in taxes, even $20,000 a year. The action step is simple. Adopt a written accountable plan and log those expenses every single month so you can have clean support. But reimbursements are only one lever. The next lever lets you move hundreds of thousands of dollars out of taxable income entirely. The third strategy is using retirement stacking to reduce your taxable income. One of the fastest ways to lower your taxable income is through retirement planning, and not just one plan, but stacking multiple plans together. This can include 401k plans, profit sharing plans, and cash balance plans. And when you combine them, you can move between $50,000 to $300,000 or more into retirement. That creates a huge deduction for the business and a major tax advantage benefit for owners and employees. And depending on your bracket, 20 to 30% of that contribution could come back to you in tax savings. There are countless ways to design a retirement structure, which is why you want a planner who understands this space. But even after stacking retirement plans, there's one built-in deduction that most business owners still don't fully maximize: the QBI deduction. Thanks to the Big Beautiful Bill passed on July 4, 2025, the QBI deduction is permanently restored. That means up to 20% of your qualified business income become a tax deduction. So you do not pay taxes on 100% of your profits, only about 80% if you qualify. But it is not a flat 20% for everyone. It depends on your W-2 wages, your taxable income, your entity type, and some specific limitations. And to remember that C corporations do not qualify. And this is why your payroll and profit structure need to be designed around the QBI rules instead of treating them as an afterthought. Federal strategies are powerful, but if you live in a high-tax state, your state strategy can make or break your savings. For business owners in states like California, New York, state taxes can be brutal, but the pass-through entity tax lets you pay state taxes at the entity level, which bypasses the personal south limits and allows your business to deduct those taxes. Multi-state apportionment lets you allocate revenue, payroll, and property across states. And if your business operates in multiple states, you can legally shift income to lower tax states when the rules are followed correctly. These strategies can save you a lot of money, but they require careful planning and state-specific compliance so you do not create new problems. Now, when your state and federal strategies are aligned, the next step is accelerating deductions using depreciation. If you own buildings or major leasehold improvements, cost segregation lets you front-load large portions of depreciation into the first 5 years instead of spreading it over 27 or 39 years. For vehicle over 6,000 pounds and major equipment, you can use bonus depreciation or Section 179 to deduct the entire purchase in year 1. And you cannot double dip, so you must choose the method, but the impact can be enormous. Thanks to the big beautiful bill, bonus depreciation returned to 100% in 2025, and in 2026, you can deduct the full cost of qualified equipment purchased that year. For the right business, they can create $100,000 to $500,000, even over $1 million in deductions in a single year. The seventh strategy is to use credit in the right way, especially R&D credit. Credit the dollar-for-dollar deductions in tax owed, and many businesses qualify without realizing it. Businesses that develop processes, software, job cost system, or internal tools often qualify for the R&D credit, and qualifying costs can include your time, your team's time, and then some of the equipment used for development. These credits can offset income taxes and in some cases payroll taxes too. The big caution is documentation. Do not call everything R&D. Use time tracking and clear project documentation to support the credit so it holds up. And then beyond credits, one of the most underrated tax strategies is hiring the people already in your home, which brings me to the eighth strategy, which is family employment and income shifting. You can hire your spouse and your kids to work in the business and shift income into lower tax or even no tax buckets. Kids between roughly 7 and 18 years old can do legitimate work and be paid up to around $15,000 a year. And then with the right family management plan, you can avoid payroll taxes on their wages. They owe no income taxes and the business still gets a deduction. That money can go into a Roth IRA, college savings account, or long-term investment, which means this strategy can build hundreds of thousands of dollars for your kids over time. But wages are not the only way to save. Your health strategy can also create powerful tax-free advantages. The ninth strategy is using health strategies like an HSA or HRA. For businesses with under 50 full-time employees, you can reimburse individual health plans pre-tax using QSE HRA or similar structures. HSAs are another powerful tool, roughly up to $8,500 for married couples or $4,500 for individuals. HSA contributions are tax deductible, they grow tax-free, and then withdrawals for qualified medical expenses are tax-free as well. These strategies can reduce taxable income, reduce payroll exposure, and then create long-term tax-free benefits for both owners and employees. You want to work with the health and tax professional to pick the right structure because the wrong one can cost more than it saves. And finally, let's look at how timing your generosity can multiply both impact and tax savings. The 10th strategy is charitable planning and timing. With the right structure, charitable planning becomes a very powerful tax-saving tool instead of just a feel-good move. You can use donor advice funds, family foundations, appreciated stock donations, and strategic timing alongside year-end revenue. You can also pair donations with qualified business income deduction planning and then bracket planning, so those gives unlock bigger deductions and reduce taxable income in high-profit years. When you line this up with your other strategies, generosity becomes one more lever in your tax plan. But even the best strategies fall apart if you do not track the numbers or keep clean records. So in the next video, we'll talk about staying audit ready and where to go from here to all of these planning actually hold up.